Hi, I'm Art Halleran, a CEO of Trillion Energy, which is a oil and gas producing company offshore Turkey and also onshore Turkey.
All right, good to see. It's been a while. I guess you've had your head down trying to sort things out, and I want to talk about some of those things today. What's the focus going to be going forward for you? Because I think it's a kind of interesting market place out there. You've had a few things to sort out at your end, and the expectation is you got to get things moving again. So what are you going to focus on?
We're going to be focusing on the gas and SASB, and our production guidance we had out there. We were going to have our activities starting, in the first quarter, and now we're in the second quarter, and we're just starting our activities. And it is the fact that we have the 6 wells offshore Turkey, and we had water loading, and it turns out that all we need to do is really replace the tubing size from 4.5 to 2 3/8. We have that all in place, and the only delay was a couple of things. One is our partner TPAO, which is a good operator. They're the government company. They like to use Schlumberger, and the cost, because we're going to go in and perforate the 4 wells and put them on production. So now we have no more pay left in there to perforate. Produce it for about 3-4 months, and then put in the smaller tubing size. And their cost estimate using a major service company was about $1.8 million, $1.6 million. And we looked at it, and we have a smaller service company, and we're in the order of, and that's 100% cost, the order of $800,000. So you're talking about $1 million difference. So we approached them, and they agree that we can then operate. So they're transferring the operatorship to us. And in Turkey, so the perforation guns, you have explosives in the tool, and in Turkey you have to go through a permit process to have the explosives. And we thought we could just get it transferred from TPAO, and it turns out we can't. So we had to reapply ourselves, apply for the explosives, and we've got that not last Thursday, but the Thursday passed. And now all we're really doing is waiting for the tractors, and we've ordered them. And because there's only so many, it takes some time to get it, but we're told we'll have them in about a week to 10 days.
Okay, so not like. But how does Schlumberger feel about that one? Because obviously you owe them money, don't you?
Yeah, I mean, Schlumberger understands they are a big company, and so we initially owed them $9 million. We paid off $3 million. We've talked to them, and they said, okay, we won't bother you for the other $6 million because we've done some of the work, some of the simulations and so on this field. They know the gas is going to come, so they said, just pay us when the gas production comes back on. You get your revenues, and they're not really concerned that we have another service provider.
Right. Okay. So you've come to agreement with them. That kind of defers payment subject to performance. And if you don't hit gas, I mean, that's gonna be, well, I guess it depends what shape the company's in, right? As to whether or not I guess that gets paid now or in some way, shape, or fashion in the future by whoever owns this asset. But talk about the rest of the balance sheet, because at the moment, in a kind of offer environment like the last 3 years has been for equities, everyone's in the same boat. It's like trying to find money, trying to find affordable money, and there's a question of what can you do with the money that you raise. Your balance sheet at the moment, who else do you owe money to?
Yeah, so as everybody knows, we owe, I think it was like $14-15 million. And a couple of them are like really key players. And that's after paying Schlumberger their $3 million. And we have about $10 million of that pretty well handled. Like Schlumberger is $6 million. Then we have another $2 million actually is an arbitration because we feel that there is some unfair billing. And another couple of $2 million, $1 million here and $1 million there. We actually have a payment plan, and they're quite comfortable with how we're going to handle that. And the other thing, so we have that, what we owe. And of course, now we look at and we say, okay, we're going to be doing the perforations, putting in the smaller tubing size. So that has cost. And another slight, I wouldn't say it's a delay, it's just happened to work out well, it's serendipity, is that from our SASB program, we had a lot of inventory. We had about $5 million of inventory that we paid for, and we have stored in Turkey, and it was offshore consumables, so it's usually the high premium stuff, so we're not going to get like, an 80% value for it. But right now we have two solid bids for some of the material that are in the order of about $400,000 each. So that works out to about $800,000 US. And then there's another group going out in the next couple of days, and will probably be another $200,000 to $300,000. So that's going to give us $1 million US. And I just said that the perforations and the first bit of work we're going to do on SASB is $800,000. We pay half that. So that's $400,000, and we have $1 million coming in. So that's pretty well covered.
Right. And what's the rest of the balance sheet look like in terms of ability to monetize assets or inventory? Are you able to?
Yeah, that's interesting. You brought that up because we have an oil field, and I mentioned at the odd time that we're actually producing. It's called Sindari. We own a 19% interest, which is a very minority amount. Our partner, TPAO in SASB, are also our partner in this oil field. And we approached them, and we'd get no value for it in our share price. And it produces about probably $2 or $3 million a year, depending on the price of the oil. And we're getting $90, but it's only about 85 barrels of oil per day. So we approached TPAO if they'd be interested in purchasing our interest. They said yes, and on April 6th, we actually put them on notice. So May 6th will be the 30 days are up, and I can't say too much on the price, but it's in the order of single-digit, millions of dollars, right? So it'll pretty well take care of any work we want to do in SASB and give us some little extra. And that's one of the conversations is that a lot of investors are saying we're going to have to do another equity raise and so on. And we just sitting here and say, okay, let's do it cheaper. Let's sell some of our inventory that we have instead of sitting there and saying, oh, it's worth, $2 million and we're selling it for $1 million. Well, that $1 million we're getting is going to allow us to do SASB, put on the gas production, make $1 million a month in revenue. And at the same time, we have this asset that, covered all the payroll and so on in Turkey, but we now expect that to occur with SASB. And so let's cash in on this asset and really, be okay.
Okay, I'm sorry, you're not unique in the sense that it's a lot of people are in the same boat, and it's how you kind of navigate these choppy waters. So appreciate you kind of sharing that. It's really then a case of what you do with it, and does that work? So with SASB, what will those boreholes bring forward for you? How do you create value from that? And I guess we'll know when you get going here. I want to talk to you about one other thing, which is obviously the 2023 year-end reserve report, right? So you've kind of stated what it is that you've got, and you talk about it in NPV 10 terms, which is some big numbers in there. How does the market should value that in the kind of macro environment we sit now? When things are tight, it's always tempting to say, well, just flog it, get some money in and go again. Or can you do more, with the assets that you've got by bringing in additional partners? I mean, I'm just interested in the kind of strategy for not just survival, but more growth. Is there a growth component to this?
Yes, I mean, that's correct. So when we have our year-end reserve report, we never lost the reserves. That's another conversation because we had the water loading. And all water loading is normally these reservoirs produce water. And when the tubing size is smaller, it has enough pressure to push it out. And that's why it's called a velocity stream, because it increases as it go up and shoots it out. Well, we had 4.5-inch tubing. and so it didn't happen. The gas is still there. So the reserve report, and that's why when we get like people like Schlumberger and so on, they don't mind waiting. The reserve report says we never lost any reserves. We actually increased the amount of reserves. These are reserves. These are not resources. And the only change we had, because on December 31st, they look at which wells are producing and which wells aren't producing. Even if we put them back on a couple of days later, it doesn't matter because that's what they have to do. So the reserves are there. They just are in proven producing and proven non-producing. And then as we bring these wells on, it'll convert to proven producing, right? For the total proven reserves, again, like I say, we've gone up to about 55 BCF, and that's net. That's after royalty, from about 43 or 46 BCF before. And also, we were always talking about water pumps and so on. And with the new guy we hired for our COO has a lot of experience in water lift and so on. Basically said there's too much gas in these reservoirs at the moment. All you need to do is perforate all your pay, so you don't have to use a 4.5 inch, and put in the smaller tubing size. And so the plan that we're going to do right now, and everybody can see the production before, we would perforate, and then we would get like 6, 7 million, 8 million cubic feet per day. And in 2 or 3 months, it would go down to about 2. And then that's where the weight of the water stops it. So we're going to perforate about 40-something meters in 4 of the wells. One of them, we're going to put the velocity string into the tubing right away. That's Akachoka 3. That's a legacy well, so it has a little bit more water. The other 3, we're just going to produce, get the flush production. And then 2 or 3 months down the road, we're going to put in the smaller tubing size, because why? We know the wells are going to get flush production. Why stop them when we can get good revenues? So in a short order, we're going to be getting a couple $1 million revenue a month, right? And then with the velocity strings, it will get 3 or 4 years or 5 years of production. Then we can put in a water pump. But that being said, on the platform also, we have Akachoka 5, which is a legacy well, which is a well that doesn't have good cement behind casing. It has a lot of reserves. We're actually, because we have a pump, we ordered it. We're going to put a PCP pump below the perforations because there's going to be enough water, and we're going to learn from that so that 3 or 4 years down the road, the learning curve is behind us. We understand.
It's all very technical at the moment.
Yeah, sorry about that.
No. I didn't mean the conversation. In terms of what you've got to deliver, and the way the market's looking at this, saying there's a lot needing to work technically. Its expectation is nothing goes wrong. But we know it is constant monitoring and tweaking in terms of managing those fields and trying to, get that kind of steady state flow so we can be, or at least you can try to comfort the market through consistently delivering revenue into the market that you guys know what you're doing. Do you know what I mean? That's the kind of scenario we find ourselves in. And 2 million a month is good. So was that a gross or a net number?
So it works out to every million cubic feet per day is about net us after royalties, about 300 grand a month.
Right.
So it adds up pretty quick. And the thing about that's sometimes I have, the issue is I make things more complicated than they actually are. So an example would be, what's the difference between the legacy wells and the wells we drilled now? The wells we drilled now are longer reach, and we have 4.5 inch tubing. The old wells have 2 3/8. So the fact is, all we're really going to be doing is perforating the pay and then threading the smaller tubing size, 2 3/8, in the 4.5, and the wells will come on, right?
Right.
And then whatever
relatively
happens 3 or
easy.
4 years down the road, we'll handle at that time, right?
Yeah. Because I think the key for you has got to be sorting your balance sheet out, right? It's getting to the point where debt's paid down. Well, one, revenue's actually flowing. You got to deliver this technically, right? Revenue's actually flowing. So let's focus on that. So your timing, what I'm hearing from you is say that I think we're going to have enough revenue, and we've had enough conversations with some of our creditors to say that we've got breathing space to do that and do the perforations, put the smaller tubing in, and get to the point where we can extract and sell into market and generate a kind of net margin there, which should start, accruing and accumulating into a not necessarily free cash flow, but money which will allow you to develop a growth plan for the fields, right? But that's going to take time. You don't want to blow your brains out or blow the balance sheet out by going and raising, dilutive capital in the market, equity in the market. So
that's exactly it. I mean, and the thing that I can let you know is that in 2023, even with our, wells flush production, and then it goes down and the water loading, we still made about $17 million revenue, right? That's not bad, right? And after we do these 6, we have another 6 when you talk about, the next layer, and the next 6 wells again are just reserves. So there's no resources, right? The first 3, we're going to, what we learned from Akachoka 5, so this is like towards the 3rd quarter or 4th quarter of this year, we're going to re-enter 3 of these legacy wells and then potentially put in like artificial lift and so on, because they had water loading, and they stopped producing at about 200 up to maybe 500 MCF per day, but they'd never had pumps in there. And so we'll just go in there and do that. So that's those 3. We have 2 sidetracks. We'll go in there, and it's about $8 million a sidetrack, $4 million ours. So the first 3, about $1 million each. The next 2, about $4 million each for us. And the last sidetrack, so it's number 6 of the 5, is a swing well. We might do it, we might not. It's actually, again, a sidetrack because it's way cheaper going into the old borehole and milling the window out, and it's to test a large stratigraphic exploration target. And so that, if that comes in, which we're fairly confident it will, because we use AVO, we got the seismic processing, so you can see the gas saturation. That'll open up a whole new targets, on our block. And maybe at that time, we can attract maybe a larger company or something, or, a debt provider or a royalty, because we've had now 6 wells, and then we're going to have this huge resource report with the one exploration, and we're seeing that there's more gas than we actually ever anticipated. And that might be very attractive, right? We'll have 12 wells producing.
Yeah, and so with this kind of like softer, less aggressive, less dilutive approach, can you give me some sort of I'm perhaps not up to date with where we are in terms of pricing in Turkey and what you're able to sell at, and ultimately what I'm looking for is not necessarily plowing the money back in in the ground each time, but where you can get to the point where you are adding dollars to your bottom line by having good margin sales, which you think, and then tell me all about the best return on capital invested would be for us to do X, Y, or Z. So what are prices like at the moment? What would you expect your margins to be? And what do you do with the money?
Right now, the price is still in the order of $10 to $12. And when I say 10 to 12, is that we sit there and we're told it's $11 an MCF, but when we work out our pricing, it turns out to be 12.
How so? What happens there?
Well, we're told that when we listen to BOTAS, so a real example is it said it was like $11.65 or 35 cents, and then we actually got paid, $12 US and MCX, which is not a lot of difference, but it is a small uplift. And what happens in Turkey is they are now importing 98% of their natural gas. Natural gas is their energy of choice. And they have 3 pricing tiers. They have the residential, which they subsidize. They have the steel factories, which is slightly subsidized, and it's because of that horrendous earthquake. They had to come up with rebar and so on. And then we sell to electrical generators, and electrical generators pay a premium for their gas, and that extra is used to subsidize the residential and the steel boundaries. And then when you look at the pricing deck, so what they do is they go out and every month they say we need a volume of gas, and they buy about 80%, 90% on their long-term contracts, and the rest they fill in on the spot market. And it's projected that the price in Turkey will go up a couple of bucks towards the end of 2024 and 25 because their long-term contracts are expiring. So until they secure, and they're trying to get away from Russian gas, so until they secure a long-term contract, there's going to be a larger percentage of spot market. And it's not going to be like $20, but it's like $13 or $14, which is not bad.
Right. Okay. So that's on the pricing. In terms of margin, therefore, your expectation is what?
Yeah. So we pay a direct op cost of about $90,000 US a month, but when you factor in like other things like perforations and all that kind of stuff, it works out about $200,000 a month. And if you're in the order of about 7.5 million cubic feet per day, it's like 80 cents an MCF. So if we get $10 an MCF, or say $11 an MCF in the market, we put in our pocket $10 at no less than $9 an MCF, right? And so that gives us a very good revenue base, and the largest cost of that would be we pay a 12.5% royalty, but it's never changed. And then so that money we're going to use to continue our development on SASB, but also we have the oil block in southeastern in Turkey that potentially in the future we're going to need some money to acceleration of maybe a discovery.
Okay, understood. Then in terms of what do you do with money that comes, because revenue is one thing, right? Margin's another, and if you explain that there should be margin there, then it is a case of the best allocation of that capital for the best return on investment, for the best way of driving perception in the market of the value of the business. So in terms of the assets that you've got, the opportunities in front of you, I mean, how would you prioritize those?
Our priority is always SASB, right?
Right.
And so we have two properties. We have SASB, which is the reserve type property, so generates a lot of cash with low risk, and we have this really potential big hitter oil prospect in southeastern Turkey. So as long as the southeastern oil block is not a discovery, we'll focus most of our cash in SASB, and it's because there are, even when I talk about we're going to do these 6 now that we drilled before, we're just going to put velocity string in. We have another 6 candidates, very low cost, and we'll get them on production. There are like another 6 or 7 reserve locations that we can carry on, and it starts to get to be more like more expensive, and so you got to be really careful of the economics. But if we hit a big discovery, and like in the oil block there, say 2024, the end of the year, or maybe early 2025, and that oil block is about 4 or 5 kilometers from huge oil fields that are producing 35,000 barrels of oil per day, new discoveries. That's a game changer. And then we sit there, okay, what is the best return on our capital? Is it, a gas well in SCSB, or is it a well that will produce 1,000, 1,400 barrels of oil per day for a long period of time? It won't be Senderi. That's why we're going to divest, or look at trying to divest Senderi, because whatever we do there, we only get a 19%, working interest, and it's just not worth.
That makes sense.
Yeah.
Okay. And then I want to kind of pick you up on communication to market. Last time we spoke, you said we're going to be talking to the market more. Why haven't you been? Was it a case of we're waiting for all of blasting explosive permits, waiting for these trucks? I mean, what's been the kind of hold up?
So there's a couple of reasons for that. And one of the reasons is we're always short of capital. So do we go with the $1.8 million with Schlumberger and then start digging another hole? Or do we look for a cheaper method? And it's just not cheaper, it's just lower cost because they actually use the same tractors and so on. And so that's $800,000. And the other one was, getting the operatorship. So we're going to operate. And so we sit there and say, okay, like I say, we're always short of cash. We have 800,000 now, which half is ours, is 400,000. But we're still short of cash. Where can we get it? Let's sell our inventory, get that in the bank, and now we can just carry forward. And Senderi was something that just came along, and we just thought, well, why don't we sell Senderi? So we're not waiting on the Senderi. The Senderi would be, it would pay for basically the oil block, anything we want to do in SASB. It was just to get the little pieces in place to not do what we did before. That's basically the conversation. And the other aspect of it is sometimes things happen for a good serendipity. Like people don't think about it. We had all these studies that said we can use these pumps and so on. And then we have a person with experience and they say, no, why go through all that cost when all you have to do is put a smaller tubing size in? And like I tell people, it's the same concept as you have a paper towel roll and trying to suck coffee up in that versus a soda straw, right? So we have 4.5-inch tubing, the paper towel roll, or let's put in the soda straw. And of course, it's going to work better. It's going to push the water out way faster.
Okay. So talk to me about what can I expect to see from you guys over the next 3-4 months or 6 months that says to me, they're moving forward, they're getting stuff done, they're moving towards revenue. Because you're kind of one of these, it's been near-term revenue for a while, and I want to see actual revenue, right? So what's your expectation of timings of that?
Yeah, so the perforations are going to happen as soon as we get the tractors. Like I say, it's a matter of whenever they arrive, we put the order in, and so you're like a week or 10 days. But I'll caution everybody because I've done this before. What happens is we perforate the wells, we get this fantastic big production. And so people should look for the big production, with the perforations and so on. And we're going to get this flush production, but they should be really happy when we put in the velocity strings, because then they know things are set and ready to go.
Okay. And how does this work with gas as well? Just remind me and the listeners. You say, right, in terms of, there's an initial sort of burst of gas, and then what's the kind of drop-off profile look like?
Yeah, so when we're going to reperf these wells, we are still going to leave and produce in the 4.5-inch tubing. So we're going to get that water starting to load up. And so what that does is that adds weight to the perfs, and so the gas has a more difficult time. So we get a steeper decline production. But how it works is that your gas reservoir is under a pressure. So it is about 1,600 meters. The pressure will be about 1,600 psi, roughly. That's lithostatic pressure. And so when you perforate that, these reservoirs are contained. They don't have water keeping the pressure up. So it's like a big balloon. And so when we perforate, the gas produces, and it's like any balloon, like it goes really quick. So we'll produce most of the gas, like 50-60% in the first 4 or 5 years. But as the gas produces, the pressure of the reservoir drops, right? So it goes like 1,600 psi, 1,500. And then normally what happens, you'll get a flush production, and then it'll level off because your reservoir size is a certain size. And you'll go from 5 million, 4 million, 3 million cubic feet per day. And it turns out the level is around 2 to 2.5, and it'll produce that for, 2, 3, 4 years. And then we'll start having its 29% decline. That's the normal one. When we put the smaller tubing size in, that'll happen. But what occurred to us is that because the water wasn't going out, it was just building up, and our well bore holes are 3.4 kilometers long, and eventually just the gravity, weight of the water is the same pressure as the reservoir, and so it stops producing. So all we need to do is one of two things. You get a pump and you pump the water off, and now you don't have that weight, and the gas pressure goes in, because you got to look at the borehole is, say, at 200 psi and the reservoir is at 1600, of course it's going to flow in, right? And the other way is to run in a smaller tubing size, so that any water that's produced, the gas at its 1500 psi goes in, and the velocity of its expansion and so on and going to surface just pushes the water out. And it can, because it's a smaller tubing size versus a larger tubing size, right? And so that's all these reservoirs are. Any gas is just pressure and declining the pressure for the production.
No, I understand. Look, all right, I think one is that I appreciate you coming on the show, right, and talking to us, because it's always been sort of this interesting potential, and it sounds like you've been sort of juggling things around on the sidelines, trying to get the kind of non-dilutive solution to the kind of the funding element, and that's great. Now it's a case of go and show me, don't tell me, deliver this stuff, and and hopefully the market reacts positively to that. So I appreciate your time today. I think potential's there, and I'll see you soon.
Yeah, okay. Thanks a lot. Yeah, I appreciate it.